studying your last two. I swim med when I turned in. The styrene down to mute. And can learn a pole that sunk he died.
Schedule 1 is one of the most important schedules in a T2 corporate tax return because it acts as the bridge between accounting income and taxable income. Every business prepares financial statements using accounting standards to measure its financial performance. These statements calculate the company's accounting profit, which reflects how the business performed during the year. However, the Canada Revenue Agency does not calculate taxes using accounting rules alone. Instead, it applies tax legislation to determine how much income is actually subject to tax. Because accounting rules and tax rules are not always the same, accounting profit is often different from taxable income. Some expenses that are perfectly acceptable for accounting purposes may not be fully deductible for tax purposes, while other deductions are available only under tax law. This is exactly where Schedule 1 comes in. Its purpose is to reconcile, or adjust, the accounting profit so that it becomes the corporation's taxable income. You can think of Schedule 1 as a bridge. On one side is the accounting income from the financial statements. On the other side is the taxable income used to calculate corporate income tax. Schedule 1 connects these two by applying the adjustments required under CRA rules. Throughout the rest of this section, you'll learn what these adjustments are, why they are necessary, and how they affect the final taxable income reported on the T2 return. Once you understand the purpose of Schedule 1, you'll have a solid foundation for understanding almost every other adjustment you'll encounter in a corporate tax return. Every Schedule 1 follows the same simple process. Once you understand this workflow, you'll understand the heart of most corporate tax adjustments. The process begins with the company's accounting net income. This number comes directly from the financial statements, specifically the income statement, and is usually transferred automatically into the tax software. It represents the company's profit before applying the CRA's tax rules. Next comes the Add Back section. Here, we increase the accounting income by adding back expenses that were recorded in the financial statements, but are not fully deductible for tax purposes. Common examples include the non-deductible portion of meals and entertainment, fines and penalties, income tax expense, and accounting depreciation. After the add-backs, we move to the deductions section. These are deductions that are allowed under the Income Tax Act but may not appear the same way in the accounting records. One of the most common examples is capital cost allowance, or CCA, which replaces accounting depreciation for tax purposes. Other deductions, such as certain reserves or capital loss adjustments, may also apply depending on the circumstances. After adding back the non-deductible expenses and subtracting the allowable tax deductions, we arrive at the corporation's net income for tax purposes, also known as taxable income. This is the amount that forms the basis for calculating the corporation's income tax. So the entire logic of Schedule 1 can be summarized with one simple formula. Start with accounting income. Add back what the CRA does not allow. Deduct what the CRA does allow. And the result is taxable income. As you continue through the course, each adjustment will study whether it's meals and entertainment, depreciation, capital cost allowance, or donations is simply one piece of this overall process. Once you understand this flow, every Schedule 1 adjustment becomes much easier to understand. Schedule 1 contains many different adjustments, but don't let the long list intimidate you. Most small business corporations use only a handful of these adjustments each year. The adjustments are divided into two simple categories: add-backs and deductions. Add-backs are expenses that were recorded in the accounting records, but are either not deductible or only partially deductible under the Income Tax Act. These adjustments increase taxable income. Some of the most common add-backs include the non-deductible portion of meals and entertainment, fines and penalties, income tax expense, accounting depreciation, and certain other expenses that the CRA does not allow as tax deductions. On the other hand, deductions reduce taxable income. These are amounts that are specifically allowed under tax law, even though they may not appear the same way in the accounting records. The most common deduction you'll encounter is capital cost allowance, or CCA, which replaces accounting depreciation. Other deductions may include capital loss adjustments, certain reserves, charitable donations, and other deductions permitted under the Income Tax Act. The good news is that modern tax software performs much of this work automatically. It transfers information from the financial statements, links related schedules, performs many calculations, and helps reduce errors. However, software cannot replace professional judgment. As a tax preparer, your responsibility is to review the financial statements, examine the general ledger, identify any missing adjustments, understand the CRA's rules, and verify that the final taxable income is reasonable. The most important lesson to remember is that Schedule 1 is not about memorizing dozens of adjustments. It's about understanding one simple process. Start with the accounting income. Add back the expenses that the CRA does not allow. Deduct the amounts that the CRA does allow. The final result is the corporation's taxable income. As we move through the following sections, we'll examine each of these common adjustments one at a time, so you'll understand not only what the adjustment is, but also why it exists and how it affects the T2 corporate tax return.